This is the Alhambra Investments Review and Outlook. The U.S. economy added a mere 20,000 jobs in February, well below expectations of 180,000, and down from the 311,000 in January. The unemployment rate dipped to 3.8%, while the participation rate remained steady at 63.2%. While February numbers were weak, the three-month average is still a positive 186,000 jobs per month, which is a pretty good rate this late in the business cycle. Workers' average hourly earnings were up 0.4% for the month and 3.4% over last year. Overall, the economic news this week was mixed. The Challenger job cut report, which has been trending higher for several months, hit a three-year high in February of 78,835. Challenger tracks layoff announcements, which can take months to actually happen, so we may see jobless claims continue to rise off their lows. Claims were at 223,000 last week, continuing a trend higher that started a couple of months ago. Claims are still low, but that doesn't worry us at this point. More positive news for the housing market. Housing starts jumped more than 18% in January. New home sales have been volatile lately, so the volatility of starts isn't that surprising. Sales in December were up to 621,000, which is still down 2.4% in the last 12 months. The housing market and construction in general have been the weakest part of the economy over the last year. Construction spending was down 0.6% in December and up just 1.6% year over year. The European Central Bank surprised markets this week by finally acknowledging the slowdown in Eurozone growth. But instead of winding down their monetary stimulus as had been expected, Mario Draghi announced a resumption of the program. You may recall that Albert Einstein's definition of insanity is doing the same thing over and over, expecting a different result. It may be past time to measure Mr. Draghi for a very long-sleeve jacket. With more evidence of a slowing economy, stocks were down on the week, bonds rallied, gold was higher in spite of the strong dollar, the broader commodity indices were lower on the week, copper and crude oil both sold off. The big losers on the week were small company stocks, with the Russell 2000 down over 4% for the week, and in spite of the falling euro, foreign markets outperformed the U.S. There is little doubt now that the global economy is slowing, and the ECB really had no choice but to acknowledge it this week. We do wonder, though, what they hope to accomplish with more monetary stimulus. Interest rates in Europe have been falling back into negative territory again, and never really rose that much after the last round of stimulus. In short, the ECB's efforts so far have been for naught. Another round of what's already failed just doesn't make a lot of sense. The failure of monetary stimulus is not confined to Europe. Japan's central bank has been trying to raise inflation for nearly 20 years to no avail. The Federal Reserve has been the most successful, but that's damning with faint praise. Trillions of dollars have been added to their balance sheet, and the 10-year Treasury note still yields less than 3%. Real interest rates out to 10 years are less than 1%. In addition to nearly a decade of monetary manipulation, the U.S. government has run persistent and large budget deficits since the 2008 crisis. While the corporate tax cuts raised growth last year to 3%, it appears the effect is already fading, falling back to the previous trend of about 2%. The two political parties today both offer some version of Keynesian theory. Democrats tend to concentrate on stimulating demand, while Republicans concentrate on the supply side. The difference between the two approaches is negligible in substance and effect. If the extreme measures we've taken since 2008 haven't worked, even more extreme measures are not the answer. If more debt was not the answer to a problem caused by too much debt, maybe we ought to explore a more common sense approach. If growth is constrained by too much debt, the obvious answer is to concentrate on getting our fiscal house in order. How that's accomplished is less important than having the resolve to do so. Historically, governments have resolved debt issues through inflation. Given that precedent, the attention paid recently to modern monetary theory is not surprising. Inflation is always offered as an easy way out of economic difficulties, but it's a false god. Inflation always hurts the ones it's intended to help. MMT is not the free lunch its advocates advertise. Getting out of a debt problem is not easy, but it is simple. Other countries have done it, for example, Canada in the 1990s. Reducing the size of government and living within our means will require political cooperation. It's a worthy national challenge we believe Americans will embrace if structured properly. We've accomplished big goals in the past, and it's time again, as John F. Kennedy said, to ask not what your country can do for you, but to ask what you can do for your country. Now, here are the week's closing numbers.